One of the most frequently asked questions from clients is, should I contribute to my pre-tax account or my Roth account? Today, we're diving into the details to help you figure out which account is right for you. Hi, I'm Erin of Truly Aligned.
And I'm Maximilian of Truly Aligned. The federal government has progressive tax rates for income in the United States, meaning the more income you make, the higher tax bracket you pay into.
So why are we talking about taxes? Well, first we have to talk about the difference between a Roth and a pre-tax account. A pre-tax account means you're putting money into a retirement account and you're getting a tax deduction today. So you're taking advantage of tax savings today. In the future, when you take distributions from this account, you will have to pay taxes at the tax bracket you're in the future. Comparatively, for a Roth account, you are paying taxes on that income today. When you go to take distributions from your Roth account in the future, because you've already paid taxes, you do not have to pay any more taxes in the future on distributions. There's multiple different kinds of retirement accounts you've probably heard of before, something called a 401k, a 403b, a TSP, or an IRA. To be eligible to contribute to one of these accounts, you must have earned income. If you're self-employed, you might have a simple IRA or a SEP IRA. These all have different contribution limits, but know that these are all retirement accounts. They do get tax advantages, and the difference we're talking about today is whether you're paying taxes today or in the future.
Erin, I love taxes, as you're aware of, and we have an awesome tax strategy video called the Augusta Rule. It talks about my personal favorite tax strategy that most people have not heard of. See in the description below for that video. As far as why is this relevant? You have to think about withdrawals or distributions in retirement. So to Erin's point, traditional accounts, they're all taxable later versus Roth accounts are tax-free. So if we think about in retirement, is your tax rate going to be higher or lower than what it is today? The US deficit has been running many years over deficit, and when that's historically happened, countries have increased taxes, though it's normally on the highest income earners, not across the board for tax rates.
Keep in mind, this is general advice. When we work one-on-one with our clients, we do a comprehensive cash flow analysis with our advanced tax planning software so that we can determine if pre-tax or traditional contributions versus a Roth contribution is right for that specific client. This is not tax advice, so be sure to work with your tax professional to determine if this strategy is right for you.
So when we talk about should I contribute to a traditional versus a Roth, we have to think about what's your top tax bracket you're currently paying taxes into. So for most of our clients, if they're at 32% or higher for their top federal tax bracket, we recommend to do a traditional contribution versus a Roth contribution into your retirement. For most of our clients, if they're at 24% or below for the top tax bracket, we recommend to do a Roth contribution. The reason behind that is for a traditional, as an example, most of the time your income is going to be lower in retirement as far as your income needs versus what you're making in your working career. So a lot of times, if you're early in your career, Roth contributions can make more sense. As your income increases and you expand your career, then traditional contributions can make more sense.
We recognize that every personality is different. That's why we've created the Wealth Archetype Quiz. There's a link in the description below. It will take 5 minutes and you can learn and uncover your specific personality type when it comes to money and the decisions that you're making. Start your journey today and stay aligned.